Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Barbara Corcoran, who is a huge fan of our show, obviously, because of what she basically literally must watch our program and then go on Good Morning America and say exactly the things we say on here.
Exactly.
Okay, so it's from an article, Self-Made Real Estate Millionaire. Barbara Corcoran says U.S. home prices won't fall, but could jump 10% to 15% if mortgage rates dip. Now, she's not just a millionaire. She's super rich. She actually is the founder of Corcoran, which is a big real estate company in New York City.
Right.
And then she's, of course, an investor in a bunch of other companies and stuff like that. Okay, so here's the premise, Juana. Mortgage rates are going to drop. Home prices are going to go up. Maybe. But let's talk about that. Why? What makes her think that?
So it's the same thing that we've been talking about. Actually, we mentioned this a couple of times in the last couple of weeks, is that when interest rates go down, that means that people who have been kind of on the edge of, well, do I buy or don't I buy, they're going to come into the market and there's going to be a feeding frenzy. We already have about a third of properties nationally that sell with multiple offers. We're going to have more. And we know that multiple offers generally mean that homes sell for more than asking price, which means that it's pushing prices up. So when house A sells for, a million bananas, then the next house comes on the market, that's going to sell for a little more because they got this feeding frenzy over here. They got maybe 8 offers and only one offer was successful, right? Because they only had one house to sell. So 7 other buyers are now going to jump over here, right, and they're going to be fighting over this house. Plus any other new buyers, they're going to come over here and want this house too. So the more buyers are interested in one house, the more buyers are chasing a limited amount of goods, then that's going to push prices up. That's just basic economics. And this is something that we've talked about a lot lately, which is the reason why my position has been that the way to actually bring home prices to level off or even taper is to increase interest rates. Because the more you increase interest rates, the more people you shave off, and then you're going to maybe have less multiple offers and you're going to have less upward pressure on those prices.
With 3% interest rates, home prices are going up like 15% a year. And I think the people who predicted increasing interest rates would tank the market, in a way were right. It dampened it, but I think that they didn't realize how much interest rates would have to go up. Like going up to 7.5 clearly hasn't done anything because prices are going up. Remember, we were above 7 last October, and then we're back at 7.5% again, and
it's not doing it.
It's not doing anything. Okay, so here's a quote from the article. The housing market is surprisingly strong. Everybody is surprised by it. Corcoran said, everybody except for us, we're not surprised by it. It's doing exactly what we said it would do, okay? Houses are not staying on the market. They all sell. 1/3 of them sell for over ask price, and there are just not enough houses to go around. So as a result of that, the housing market is as strong as ever, and it's so frustrating for buyers. It is frustrating for buyers.
It is. And who it's also frustrating for, and you're going to scratch your head, but it's also frustrating for sellers. When you're thinking, what? The sellers are getting to run the show. Well, yes and no. It's frustrating for would-be sellers because would-be sellers are buyers on the other end. They have nothing to buy on the other end, so then they're not able to sell because there's nothing for them to buy. So that's why I'm saying that it's frustrating for would-be sellers.
Here's another quote. There's not a lot out there, Corcoran said, adding that everyone is having a hard time right now. But I can tell you this, house prices are not going to come down.
And I agree with that. Now, does that mean that in every market, house prices are not going to come down? Of course not. Okay? We're talking when you're looking at the whole market, not particular pockets. There's a lot of variation between particular pockets, obviously, because we've talked about this a lot. Real estate is hyper-local, so there's a lot of variation. But when you're looking at the whole broader market, house prices are not going to decline because of supply and demand. There's less supply, more demand, so prices aren't going down so long as demand is outstripping supply.
Here's another quote. This is the big one, okay? When mortgage rates come down, Corcoran nearly said, all hell would break loose before she realized she might not be able to say that on TV. I think you say hell on TV.
I think maybe she hasn't watched TV in a while because they say a lot of things on TV that they did not used to be able to say.
I know, yeah. Buyers waiting on the sidelines will jump into the market, and houses are going to go up in price all over again, she added. I wouldn't be surprised if they go up by as much as 10% or 15% when that happens. Now, we do know, because we did a video on this a couple weeks ago, that a lot of the institutional buyers one of them specifically said they wanted like 4 or 5x their portfolio by 2030.
Right.
So obviously it appears, now remember, price, basic economics lesson, you have supply and demand, and where they meet is price. That's literally how price is determined. Interest rates are not the driving factor for price. It's supply and demand. You could argue that interest rates will affect demand, but apparently they're not affecting it enough.
Right.
Right?
Yep.
Okay. So another quote from the article. So somebody had asked her, hey, I'm thinking about selling my house right now. You think that's a good idea? This is what she said. But if it was my house, I would wait until next year when all the buyers come off the sidelines, when interest rates come down. I'm going to get a lot more for my house than I would right now, so they have no problems. Nobody's feeling bad for the sellers. So I want to talk about that. Macroeconomics. We'll take a step back. The airlines are making more money than they've ever made, at least the big four. The other smaller ones are not doing that well, but the big airlines are just absolutely making a killing, right? NVIDIA just announced blowout record profits, like tons of money is coming in. The economy is doing really well. Matter of fact, it's doing so well, Jerome Powell came out and said, hey guys, we may keep raising rates because we need to cool this thing off. It's getting too hot. Even though inflation's at only like 2.4%, I think they're still looking at forward-looking stuff, right? So there is no guarantee that like next year interest rates are going to be, we did a video where we talked about that, and some companies were predicting like 4.5%, right? Right.
I mean, I've seen people predict anywhere between 4.5%, 5.5%, that sort of thing. My take on it is I don't see anything below 6% for next year, but that's just me. And the reason for that is I think the Fed is keeping their eye on what their mandate is, which is to shepherd the economy and to shepherd really a 2% inflation rate, which is arbitrary, I grant you, but this is what they're shooting for because their idea is that that's going to serve the economy well for the long term. And I respect that. I respect not being all over the place. I respect having a long-term vision. I respect somebody who understands that it's not about pleasing particular interests, but what's best for the economy in general. And so I appreciate Jerome Powell and the Federal Reserve keeping their eye on the bigger picture rather than on particular industries who would benefit from lower interest rates. Now, having said that, and I've mentioned this before, Jerome Powell is also very concerned about the amount of spending that Congress is doing and the amount of borrowing that this country is having to do in order to meet its financial obligations. And I don't mean consumers, I mean the government. And remember, the government then has to go out and borrow money at these interest rates. So that is a concern that I think the Fed also has. So that's what they have to balance. They have to balance the economy at large, and they have to balance their own spending and borrowing in order to keep the government going. So I think that's a really difficult needle to thread.
If you are a member of Congress and you're watching this video, stop spending all our money, okay? It's our money. Stop throwing it away. Start borrowing a bunch of printing a bunch of money and spending it. You're messing with the housing market.
Well, there's a whole video on that. But
there's a whole video on that. Okay. Here's sort of, I think, an overview that a lot of people probably will agree with. Housing is a scarce commodity. Mm-hmm. Okay. And yes, they're building a lot of apartments, but who cares? People want to live. People don't. The dream is not to live in an apartment, right? Unless you're maybe in New York City.
Right.
People,
Look, think of apartments this way. Apartments are temporary housing. Everybody's goal is to have their own place, something that is their own, that they can stay there for as long as they want, that they have control over. So apartments are great because they're temporary housing, but they're not permanent. For most people, apartments are not that's not their end goal. So that's what we want to emphasize. So just because apartments are being built, they're needed because people need to live somewhere, but that's not where people want to end up. That's just a temporary solution for, and a step toward home ownership.
Right. But, everything has changed because now people are, spending more time at home. They're working from home and they desire, a better location, a better whatever. You've had people who are living in a house, in the city maybe, and they decide to move out in the burbs and buy their own individual houses. They created all this extra, demand for housing.
The interesting thing about all these apartments that are going up, there are a lot of them that are quite affluent, quite luxury. And I think the end goal of some of these developers are, yes, short term, we're going to have these be apartments and have people rent them out, and that's great. And when the market turns, I think they're going to convert them to condos. We saw that in the early 2000s. There were lots of condo conversions. So I see that happening again at some point in the not too distant future.
Yeah, I wouldn't be shocked if, they probably get some kind of credit, mm-hmm. or it's easier to get a permit to build multifamily instead of just building condos. Mm-hmm. And then later they just go get them condo mapped and mm-hmm. sell them.
Right.
And that's what they do. And, we had that in the, 20 years ago. That was the big thing. Yeah,
there were a lot of, 20 years ago, there was so many condo conversions that there weren't a whole lot of apartments to rent. So I do see that kind of making its way around again. When that's going to take place, I can't say, but I certainly see that. And what makes me think that is the type of apartments that they're putting up. These are really nice apartments, nice areas of town, nice amenities. These are apartments that are very likely to fetch a handsome price when they are converted to condos.
Are the ones over in downtown Summerlin, are they apartments? They're apartments, aren't they?
Yes.
Aren't they like $3,000 or $4,000?
Yes.
Just to get in. They're not that big.
No, but they're lovely.
They're super nice, but mm-hmm. they're $3,000 or $4,000. You can
yes.
easily buy a house.
Yeah.
You could buy a house in Summerlin,
mm-hmm.
and if you put 25% down, mm-hmm. and have a $3,000 or $4,000 a month,
right,
payment, you'd have a much bigger house.
Right.
Yeah. So.
Yep.
Okay.
Got anything else?
No, not really.
Okay, so one of the things that Barabara Corcoran said in the interview that I disagreed with was she was talking about variable rate mortgages. And her position was that they're not a bad idea. I am not a fan of them.
You mean adjustable rate?
I'm sorry. Yes, adjustable rate mortgages. Okay. I'm not a fan of them, and part of it is that I had a lot of experience with people who had adjustable rate mortgages that led to foreclosures. So of course that has impacted my view of them. But I just happen to think that people do better with fixed rate mortgages. People do better when they have the opportunity to refinance rather than not being in control of that adjustable rate. So, I understand her position that she feels that that's a good option right now because it gets you in the house at a lower rate right now. And yes, the rate adjusts over time. But the idea is that perhaps by the time the rate would become untenable, you'll have the opportunity to refinance at a lower rate. I understand all that. I just think that there's way too much uncertainty, and I happen to think that our homes need to be a safe place, and we need to have a very firm grasp on our housing expenses. That's one of the reasons why we buy a home, right? Is to fix our housing costs versus renting where our rent costs go up uncontrollably. So when you buy a house with a fixed rate mortgage, then you're controlling that cost. So that's why I disagree with Barabara on that.
Well, I agree with Barabara a little bit, and this is why. The ARMs that they're giving today are not the 1 year ARMs where you just get in cheap for 1 year and then the rate goes up to some crazy amount, right? almost all the products today that are out there, 90 something percent of the ones that are offered are 5 and 7 year arms. It is a fixed rate for the first 5 or 7 years. It's less than the going rate. So the 7 year arm is a little higher than the 5 year. The 5 year is the cheapest arm right now.
I've seen some of them that adjust after 1 or 2 years, and those make me really uncomfortable.
The numbers are that almost nobody is. I don't know how many people are offering those, but statistically, of the 8% of loans that are arms right now, 90 something percent are 5 or 7 year arms.
Right. So the loan products that I've seen out there,
because the problem is right now the difference in interest rate between the 5 and the 1 year is not substantial.
Right. So the ones that I've seen, they have this rate buy down where you're buying the rate for the first year or two. You're buying the rate down, and then it goes up, and that's what I'm talking about.
But if you're doing a 5 or 7 year arm, I think that's totally fine, because there is almost what are the odds that in the next 5 to 7 years interest rates only go up? All they have to do is go down once. Just at one point, rates drop, and then you refinance it to a fixed. Or here's another example: you're military, you get 5 year orders somewhere, you get a 5 year arm. So what you do is at the end of the 5 years, you sell the place or you refi it.
Mm-hmm. So I agree with you. If it's a 5 or 7 year arm, then those I think are fine. It's the ones that are 1 or 2 years.
Yeah, those are stupid.
I don't like those at all.
No.
So, all right. So we've given you lots of information. Hope that it was interesting, entertainment. You got something out of it. Maybe we made you laugh. So we appreciate you watching. Please remember to like the video, subscribe, hit the notification bell, share the video, leave us comments, tell us where you're watching from, and we'll see you on the next video. Bye.
Bye.